Okay, let's get started. Welcome to our webinar, and thank you for taking the time out of your busy day to join us. We're happy to partner again with one of our most popular speakers to bring you this webinar today on Harvest Your Profits with Option Strategy Decision Trees. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will be happy to answer them at the end of his presentation. And to just tell you a bit briefly about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform as well as free trading tools to help you spot those option trading opportunities. Also, recording of this video will be available on eOption's YouTube channel in the next few days, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe today. So before we start our presentation, I'd like to walk you through our disclaimer. Options trading does have risks. And if you take a quick look at what's on the screen, I'd like to turn your attention to the fourth bullet point on the bottom. So it says that options carry a high level of risk and are not suitable for all investors. Certain requirements must be met to trade options through Regal or any of its divisions. And there is something called an options disclosure document called the characteristics and risks of standardized options. And feel free to contact customer service at eOption, and we're happy to provide you with this booklet. But we encourage everyone to read this booklet before they start trading options. So now I'd like to turn our attention to our speaker, Teddy Kekstadt. He's done many webinars for us, and we'd like to welcome him back today. So Teddy is a professional trader and has over 34 years of trading experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years. And he has been an institutional market analyst for over 25 years. He currently serves as president of Forex Trading Unlocked and is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University in Chicago. And without further ado, I'll turn it over to Teddy Kekstadt. Thank you.
Thank you, Gina, very much for that amazing introduction, as always. And I'm just getting the share screen up. And now I think you should all be hearing me and seeing me. I have the eOption trading platform pulled up for us here. We have on this screen right now, we have the account summary page. If that is eOption, you can download join as a paper trading account or obviously a real account. The platforms are the same. The one we're using today is the paper trading account. And we'll be using various screens. We'll be looking at the positions and orders screen. We'll be going to the trading screen. This is where we'll be entering the different potential orders on the various trades that we're finding today. And our account summary, as you can see right now, we have no positions, 0. We have a balance here, which since we've been doing these webinars and using this platform, we're actually we're up over 5% now. So that's combined with all of our strategies as well as the ones that we've used with some of our viewers. So, and we're going to be going over various stocks today, and we're going to talk about decision trees. A lot of times people ask me, they're like, what is one of your key things to using in trading? One of my biggest keys is using decision trees. When I was a young student, I learned about them for different processes to figure out, the answers or directions in which way you would go, especially in math and science. And they're very applicable to options trading, let alone trading in general. So we're going to be talking about various strategies today. We're going to talk about potentially long puts, long calls. We're going to talk about vertical credit spreads. We're going to talk about straddles and also calendar spreads. So these are all very basic strategies. And the reason we use a decision tree is to know when to apply these. So it's one thing to just apply technical analysis, but when you hone it down to certain market phases and certain market patterns, then you know what are the most optimal strategies to use. And that's when you really start to increase your profitability. And especially when you talk about something like vertical credit spreads too, which now, I don't know, option, you have to ask them on your accounts. If you're getting interest on your cash balances in your accounts, credit spreads, when you take in obviously a credit, you're increasing your cash balance, you'll be earning interest on that, which is something that floor traders used to take advantage of tremendously back in especially like the 70s, the 80s, and the 90s. So that's a bonus. So that's if that is one of the strategies that's in use, just to let you know. Okay, so we're going to be looking at various stocks. And as far as all these strategies, we're not going to go into total detail on them. We've done various webinars on puts, calls, all these strategies. As Gina mentioned on the YouTube channel for eOption, we have past webinars. You can look at those, and we go into complete depth on just those strategies themselves. And make sure you like and subscribe to their channel as well as mine, Forex Trading Unlocked. So, all right, without further ado, let's pull up. So we have the market we know has been going up for the past couple of weeks, the broad market itself. And now we're going to take a look at, the CME stock. So not that there's any bias, I spent a lot of time there, but it just happens to be that this was a good one to look at. Okay, now on a daily basis, you can see that this market has been trending higher. It's been making higher move highs and higher move lows. So, and for those of you that are not totally understanding what I'm talking about, you can see like here and here, we came off this low back here, made a higher move high, and then here we bottomed here, we made a higher move low, and then once again up here we made a higher move high. So overall, the trend, as you can see, has been bullish for the CME stock. Okay, so that's on a daily basis. However, what we do notice is that over the past couple of months, you're starting to wedge. Okay, so this is another technical thing. We're not looking at any fundamentals here or any type of strategy yet. So right now we're just breaking down the market. So what do we see here? We see that the market is trending higher. Okay, and we also see that we have the indicator here, the MACD. This is pretty much on the overbought, getting ready to cross. Usually that means it's an indication that the market is getting ready to go higher, at least in the short run. At least there's a higher potential for that according to this indicator. But remember, all indicators are lagging, okay? So we know that the trend is moving, but overall, over the past month and a half, even though it's overall been trending, it's been going kind of sideways and it's wedging. So that means usually when the market starts wedging, it's getting ready to break out, either to the upside or to the downside. Okay, so now when it comes to a decision tree, what kind of trades will we put on? Now, normally you would just think, oh, if I want to get long this, take an opportunity instead of buying the stock, you'd get long calls or maybe even some vertical spreads. One being a credit spread where you would put on a put credit spread, or you could put on a debit spread, which would be used with calls. But I wouldn't suggest that for this type of methodology right now, because we don't want to get into whether you're not to use debit or credit, because they're pretty much the same thing. It's just a matter of which one you're more comfortable with, but also the pricing. So that's why we'll see how the pricing goes with these as we move along. So when you use a decisions tree, you have three components. Okay, we have one is the strategy, which we've already discussed which ones we'll be using. Then we have your bias, whether you have a directional bias, okay, and whether it's very strong in the short term or if it's more of a long-term bias. And there's also sometimes you have pretty much a short-term range trade neutral bias. Okay, so how do you trade these different markets? Okay, so on a decision tree, the third component is the technical situation. Okay, so we already know which strategies we may or may not use. We know that right now, directionally, this market is trending higher because of the higher move highs and higher move lows. We have an indicator that is showing that it is starting to come into a position where you may start to see some buying, meaning that the bulls will come up and we'll see higher move highs. So directionally, odds are right now with this indicator and with everything that's going on with the trend is that we should go from this higher move low and take out this previous high here. Now, ironically, we have this super trend indicator going on where it was when it was green, it was bullish. When it gets to this red mark, you can see how the market went sideways and it's wedging. It really didn't sell off, but right now that sell signal is in place, which you can see that the high was the initial risk for the sell signal for the super trend, and it keeps on decreasing over time as the market makes lower move highs here. So now you have this area of 221. We know that the market's trading at 216. Okay, so we know we have a $5 barrier between when this other indicator would also go positive. Okay, so now what do we look at? We know that if we were very bullish, a call would be a good strategy. Now we know that with the trend, that would be a trend trade. So a call is a potential, okay? But it's when we are most bullish is that we use a call, okay? So a call situation, are we very bullish? The market is trending higher. It's near its highs. It is still a very bullish indication. If there's a breakout to the upside, that would be a very good play. So right now we're going to look at as calls as one of our potential technical situations that we're giving us that option strategy available to us. Okay. Obviously, a put is something we wouldn't be doing, because a put is when you're bearish. When you're buying a put, you want the market to go down. So by using a decision tree from those three components, we know that a long call situation is a potential for there. Okay. Now, as far as a vertical credit spread, now when it comes to credit spreads, there's an interesting thing, because that's when you have a directional bias, but it's when you're very close to expiration. So we're going to have to check, since we're bullish right now, if there's a credit spread that has a pricing with a short-term option. Like, so right now it's the end of November. The next closest expiration, we're on expiration right now for November. So that's too late. December is already pushing a higher, but you're almost at that 30-day mark. You're at 28 days or something around there for expiration. Okay. So anything beyond that, you definitely wouldn't want to do. So we'll see what the pricing is for the December options on that one. And then we have straddles. Now, straddles that we mentioned would be when you have an immediate move is expected. Now, we are in a wedging situation. We do know that because of the way the market's trading sideways here, and you're coming off of this, once again, higher move high and higher move low, if the trend, if it's going to break out to the upside, we have a good chance at getting above the previous high, which is around 221. So we're looking at least a $5 move. Okay, so that's a good move for a straddle play, because you definitely want to have market movement. And since the market is wedging and we're coming into a holiday market, it's very likely that if this stays sideways into Wednesdays and Fridays trade, which will be short term, it's sometime between Friday and next week, you'll probably see a breakout. I mean, could a market go sideways? Absolutely, it could. However, right now with the trend and everything else, it's pretty much indicating that the market does want to at least make a move to the upside. Okay. So we'll look at straddles also. Now, here's the thing is, remember, for the straddle, you want an immediate move. Once again, because the market's wedging, we're expecting it to at least challenge that super trend level at 222. Okay. So now one of the key things remember, we have the three components. So we have a strategy, straddles. We're also looking for an immediate move, or certainly soon to be move. So we're looking within the next week or so. And then we have another thing. We have remember the technical components. And this is where we're going to now go to the e-option platform after this. What are the components that you need for straddles? One is the market is wedging. What do we have here? We have a market wedging. So one characteristic is right there. Testing a trend line. The market today is coming up on that wedging trend line. That's factor number 2 for technical. Then we have a cluster of closes. A cluster of closes means where you haven't really gone anywhere overall. And if you look at where is the average closes here, somewhere around 213, around basically 210 up to about 214. So you have a $4 range for a stock that costs 200 and some dollars, and that is where you basically an opening and closing every day. That's what is called a cluster of closes. Component number 3 for as far as technical situation. Then we have open interest increasing dramatically. So now that's the one thing is that when it comes to volume and open interest, that one is kind of a question mark, okay? Because especially when we're coming around option expirations and things like that, you get false spikes in volume and also open interest because of rolling over of positions. That gets very complicated. We're not going to get into that one. So that's one component I look away from. It's for advanced traders if you're going to use that component. But the other three lock in. So straddle is now also a component we're going to look at. Calendar spread. Now here's the thing is, if the market wasn't wedging, if it had been going sideways for a long time, then we wouldn't be looking at straddles because we wouldn't be looking for a big immediate move one way or the other. Calendar spreads will be where we would be at. Okay, then that's something we'll look at with another potential trade. So now that we've isolated the situations, we know it's either a long call, a vertical spread, or a straddle. CME, and we know the market's trading at 216. So let's go right now to here. We'll go to CME. CME, we put in our stock. Okay. Whoops, got put on trading. My bad. There we go. So we have the trading. There you go in the middle of the thing. We're going to put in CME for our symbol for our stock, for our option ticket. So now we're going to do add option. Okay. So let's see just what the call is. So buy to open is the first step. Quantity 1. We're going to have an expiration, whether it is a straddle or a outright. We're not going to do a short expiration. We're going to go towards, we could do the December 22nd, but let's go just over 28 days because this, unlike the vertical credit spread, which we will look at, that's when you want to do shorter expirations. So we'll look at that when we get to those pricings. And this is how you figure out your pricing models also, depending on your strategy. And once you know if you use your decision tree, once again, you know your strategy, your market bias, whether it's bullish, bearish, extremely bullish, bearish, or neutral. And then you also have your technical setups that confirm which strategy you want to, or when you use those strategies. So we have the, what was it? It was the 216, correct? 216 strike price. So we'll look here on the CME, we have a 210 and we have a 215. So let's look at the 215 call. Okay, so if we wanted to just buy the call, remember when you're buying, you have to buy the ask. When you're selling the bid, okay? So right now, the ask is, this market's jumping around the CME here. It was just about, it went from $4 to $6 ask. Now it's at $4.90. So this has got some good liquidity. There's a little trading going on here on the CME. I wonder if it's because they're watching this webinar live right now. No, probably not. Okay, so here one thing right now, we're looking at the bid and the ask. So originally when I first pulled it up, it was pretty wide. Usually what you want to do is when you start to see a big wide market, especially in a very liquid stock, you want to wait a while and see if the market pricing settles down. Okay, especially because we're close to expiration. So now we have a 60 cents to dollar. Basically, it's moving around. So for around $500, remember this is $5 here. You multiply times 100 for option pricing. So if we wanted to just get long the call at the 215 strike price, let's make this 215. So you visually know where we're at. And for style, we'll go for color of purple. There we go. Okay, whoops. Sorry about that. All right, so we have the 215 strike price. This is for the call right here, which is just below the market. So that means since the market's just a little bit above it, if it was right at 215 or so, it'll be at the money. It's a little bit above. Right now, it's $1 above it, so it's a little bit in the money now. So that means this call is a little bit rich. Okay, so as we were talking right there, yeah, it keeps the ask keeps on jumping up. So what we're going to do, because of the strategy here, we're going to execute one call. So right now, for the price of $4.92, we place the trade, we confirm it, and execute it. So right now, because of the decision tree, we knew that a call position is a good position for the CME. Once we looked at the overall market, we know the overall market, even though it's a down day today, has been trending higher. We're coming into a holiday market, so we know we're expecting a little bit of a thinness of trade, but right now, because of the technical situation, we're looking for a breakout. So there's the call situation. Now, let's say you're like, Teddy, you know what? I like CME stock, but it's been railing for a while. And maybe it's going to break out to the upside. Maybe we're going to see a spike where it shoots up through 222, maybe hits 225, and I think it's going to fall right back into this range where it's trading right now. Maybe you're thinking, well, okay, if it does that, you could still get out of a call at a good price, but you know, what happens if it doesn't go anywhere? Well, what if the holiday trade comes in? Maybe you'd rather wait till the holiday is over if you're really going to do a call trade. But you're like, wait a minute, I don't want to miss out on the move. Well, so we are expecting a move. So what do? We look at the straddle. Okay, so now we go back to our e-option trading platform. We're going to keep the buy to open with the 215. We're going to keep that same strike price. Okay, we're going to add an option, and we're going to buy to open. And we're going to go with the December 29th. Now, when you do a straddle, you got to remember a couple of key points. When you buy a straddle, the quantity has to be the same of both the call and the put. That has to match. The expiration date, which we have December 29th, those have to match. And then the strike price has to be the same, which is 215. So now we have a put and a call. And now we have the market here where we could sell the straddle, which we're not going to do, for 1020, which would be 1,200, or we could do the 1210 for a debit for that. Okay, so times 100. So we're going to put on that. Now here we know we have a month to go. All right. So looking at that, we're going to verify the trade. It's going to cost just over $1,100. We verify it, and now, shabam, there we go. Now, what do you do with these two trades? So now we know that from here, from 215 on, we know that we had paid. We'll go back to the account summary. We go to, open positions and orders. So here we go. You can see that we have the put and the call. Now you see here, because we put on a spread, we have one put, which is part of our straddle, but we have two calls. Remember, we bought the same strike price. So this is two separate positions, but on your summary here, it's going to show those. So you know that right now you have a total of 3 options, 2 trades. One is a directional trade, which is the call. And then the other one is the straddle, because right now it's the same whether it goes up or if it goes down. The technical situation is the same for the straddle as it is for the call. The only thing is the straddle covers both sides of the market. Okay, so now let's just say that the market does get up to test where the super trend is. We'll do this in yellow, and we're going to make it dotted. Okay, once we get through this explanation, the other ones are going to go much faster. Okay, so there is a $5 move. So we're at 216. So let's go to 211, right around there, and we'll put that. So if you look at this as far as how much the market might move, considering where it's trading at right now in this area, if the market continues to wedge and you're right on the wrong on the call, well, it might come down and trade around 211, whatever. You'll have time to get out of it if the market keeps going sideways. And if the market starts to fall, if it takes out new lows, for instance, like if it gets below this 211 mark, that would be a good indication that you might want to get out of the call and just take a small loss on the trade. Okay. So where it costs $500 to get in, you might end up getting out of it at, say, $250, $300. Let's say if it breaks over the next couple of days. If it's in 2-3 weeks from now, you still probably would be able to get something like around $100 to $150. So you would be able to recoup some of your initial investment on the call if you're wrong. However, with the straddle, if the market goes down, you don't care. You just want it to move. So in that situation, you're covered. Okay. So in that way, let's say the market does go up to 221. If it rallies $5, well, then you're going to be making money on the call. Obviously, you're going to be losing money on the put. But once you get up here to this area near these highs, odds are very good that you're going to have volatility increasing for this option, for the stock. Okay, that right there helps to bring up the pricing of your option. So even though your put is going down in price because the market is going up, the volatility factor is keeping it from going down as quickly as it normally would be. So that's a good element right there for your straddle. So the pricing on the rally should outpace that decay that you have on the losing leg of that trade. Okay, so that's a nice little area. And then if you break out of 221, so then on the call, obviously you would be up more than $5 on that one, which would be up $500. If you cross that area right there, once you hit 221 at expiration, that would be your break even point. So anytime before that, that you're above that, that would be all gravy, you know. And if you can, especially if it shoots up and let's say it gets up to 223, 225, you're looking at making 100% return on your call. Okay. Now on your straddle position, you wouldn't make quite as much money as on the call, but you're covered for both directions. Okay. So you would make money if, let's say, if it shot up to 220, had a $10 rally, but you're not going to make as much. Okay. So instead of making 100% return on your option, depending on the volatility factor and a couple other things, you would be probably making around 60% return on your money, which also, if you think about it, you're looking at an investment or a trade that you're not going to have on for more than a month. You can't have on for more than a month because of the expiration. So the potential to make 60 to 100% on either of those positions is a very good one. So we did talk about the vertical credit spreads. So now let's take a look at that before we jump on to another market. Okay. Because now that we're starting, I think you're starting to see how we break down, once again, the strategy. Then you have your directional bias and then your technical situation. These are the three elements of the decision tree. Okay, so we know our strategies, very basic. Anyone can do them. They're also, just because they're basic doesn't mean an advanced trader doesn't do that. I mean, whether you've been trading for 1 year or 50 years, people do use these strategies. Okay, now the credit spread sounds like it's a more advanced strategy, but it really isn't. So what we'll look at here is we're going to change this. We're going to get rid of this position here on the call. So, and as far as the buy to open, the put, okay, now remember with the credit spread, we want a shorter expiration. So we're going to start with that expiration and then work our way down. Okay, so on a credit spread, we would be selling to open the near option. Okay, so sell to open, then we're going to add a position, and then you're going to buy to open the next lower option. So 215. So let's look at it, would probably be 210. 210 is right. Okay, so for 210, okay, so see how this says a credit? So if you were to right now put on this position for this credit spread, now the thing is, the time period going out is a full month. Remember, you don't want to have that much time. So let's see if we can go half of that. So we know where we're right there. We're at a 360 bid, $2 ask. Let's go to December 8th is pretty quick. Let's go to the mid-December option. Okay, so we're going to go with 215 again and 210. So we have the 215 that we're selling to open and the 210. Remember, this is a vertical credit spread. So now why are we using puts? Because we're expecting the market to go up. So since we're expecting the market to go up, we're selling the closest put to where the market's at and buying one below it. So no matter what, if the market falls out of bed, our only risk is the credit minus the difference of that $5. So between 215 and 200 is $500, and our credit is going to be somewhere between 250 and 300. So the worst that you can lose is 250 to 300 if the market was to totally collapse on you. Okay, so now this one here, you look at the difference in pricing, it's like, what did I say? It was $3 at 250. It's basically the same and shorter expiration. So this one we take off the risk by shaving off a few weeks. This one's only got 2 weeks to go. And the best part about it is if it goes nowhere, you're fine. Now, only if it goes down, then the worst that can happen is you lose that 250. But you're basically risking, it's around a 250 margin. It's a 1-to-1 risk on this trade. So we're going to put this one on. 280 is the credit that you take in, and shabam. So now what does that mean? So now we have 3 trades, and we did the credit here. So let's go to 215 and 210. So 210, which is right below where our marker was for that other one. So we'll go here. Let's put this in. Okay, and then we got, let's change the pricing to 210 for that quarter, because that is a big difference. Okay, so excuse me, as far as our vertical credit spread, as long as the market doesn't take out these lows, which if it did, think about this. If you bought the call you would be losing, you would be out the $500. If you did the straddle and it goes down like this, well, then you'd be making money because remember, you don't care about the direction. The vertical credit spread, if we're right about neutral to higher trending, you make money. The worst thing that happens is it falls below here, and by expiration, if it doesn't come back up above this 210 area, then you would have a negative mark. But anything above 210 and that credit you took in is 100% yours. And remember, you'd have to check with e-option. I do not know if they pay interest on the cash in your accounts, but when you take a credit, as long as it's not differentiated as a margin money, which I don't think it would be, you would be gaining interest. Like this didn't mean anything a year ago or the last 10 years, but now with interest rates going up, if you're getting a 5%, I don't know, APR on your account, any cash, obviously, you know, if you're holding for a month an extra $280 or times how many options you did, think about that's why floor traders were really credit spreads years ago were very popular, because when you're getting 8% on your money market on the cash in your account and you're selling hundreds of these things, you know, all of a sudden you have an extra $10,000, $20,000 for a month sitting in your account gaining interest at, you know, that. Well, that starts to add up over time. It definitely buys some lunches, that's for sure. So I think through these examples now, hopefully you're getting a good idea. All right, so let's see. We have some questions. You had the wrong strike price for your lower leg. The lower leg, no, the lower leg. I think you're talking about the credit spread we just did. That is the right thing for a credit spread. You have two legs. You have the initial put and then one below it. Okay. And when you're doing puts, you sell the initial put, the closest to the market, and you buy back the lower one. So it is two different strike prices. For the straddle, it would be one strike price. So you would be correct on the straddle. You have to have the same strike price. Very good question. So what was just asked was you put the wrong strike price. In this last example for the credit spread, remember, we sell to open, same quantity. You have the same quantities for the spread. You have the same, you have the different, you have the same expiration, but the strike prices are different. They're both put. So everything is the same, except for you're selling to open the closest to the market below it. And then you're buying the one that's further out, the lower leg, the cheaper one. Okay. That's why you get a credit, because you're selling a put that's worth more than the lower one. So good observation. And now I think this should be clear to you of why we have the different strike prices. So this was initiated correctly. Okay, so that's a very good observation. Account summary here. You have, we go back to positions and orders. You can see that all of a sudden here we have an accumulation from the trades that we put on. We have we had two from the last webinar that I actually got out of today. So we have multiple CME trades we have on here. We have the quantities. Remember that we started out with the call, then we did a straddle, which gave us a net value of 3 options. And then we just did a credit spread where we're short one and long one that offset each other. Okay, so 3 total positions that we figured out from our decision tree. And now it's going to start to speed up. So the 3 components of the decision tree is strategy, directional bias, and then the technical situation. And what is the one nice thing that this does? It removes complete subjectivity. One of the things I tell people when they ask me, like, what do you think are one of the core ingredients besides money management and whatever? I'm like, lack of subjectivity. When you're subjective, let's say you have any investment manager, if they're constantly using multiple strategies or whatever, or just really just kind of feeling things around, past performance is never indicative of future results. But with that, you definitely know that you have nothing to really track as far as the data of how you're doing. If you are following, like, for instance, the decision tree, now, obviously, you're going from one stock to another, you're going to have different results and different trades. But when you apply the same method, the same methodology over and over and over, which defines your targeting, your risk parameters, what to do and what not to do. That's the key thing, is versus where you just look at the market. Like when we're just doing webinars on a strategy, we'll say, okay, would this fit the situation? Absolutely. There's multiple reasons why it would. But when we get back to the decision tree, these are the reasons that this is when you do it. You have other reasons that may say, why not put on a call or a put or a butterfly or whatever? But if you don't have these three things line up, your odds of success decrease. Does it mean you're not going to have successful trades? Absolutely not. Does it mean you're going to have more losers? Potentially, I believe so. Statistically, that's usually how it works out. So subjectivity is removed from this process. So if you look at some of our other webinars, you'll see how when we're teaching one strategy, it's about just implementing those strategies. But when you really want to lock in profits and boost your profitability and put the odds of success in your favor, removing subjectivity, money management, these components, and especially using something like a decision tree makes it very easy. Like, trading is mechanical. It's not that it's totally mechanical, but it's very automatic. You just do the same thing over and over. It's very repetitive. The market conditions, the levels will be different, but the conditions are basically the same, just at different levels. So now let's go on to our next example, because we can really start to go into some other things here. So let's look at something everyone knows. It's Christmas time. Let's look at Walmart. Okay, shabam, nice trend, and then boom, we have a big gap here. Okay, big sideways on the chart. It was trending higher, making higher move lows, higher move highs, as you can see. Remember, we did that in the last example with the circles. Come after this higher move high. We did not make a lower move low. Let's get rid of this volume here to make it just a little clearer for you. Okay, so you can see here's this low. We came down to here. Big support area right now. What's going on? I would say that if you look at this, obviously, if we come down here, then that would mean will have made a higher move high and a lower move low, which sets the market up for big sideways. So let's get a bigger picture. Okay, look at this. Now we go weekly. So last week, and especially what it had to do with a lot of the consumer stocks were hit. I don't know if you were paying attention to the retail numbers that came out in earnings and some expectations, but there was a lot of downgrades and a lot of selling pressure that went out across the sector. So Walmart being one of the biggest, of course, it got hit. So you can see overall the trend has been higher. Okay, obviously this week it's trying to bottom and hold the low, but here you're coming off higher move high, higher move low, higher move high, but this is not just a weekly, this is just a couple days. So of big volume, you took out more than a month's worth of trading on this break, but still the market overall is a bull. But we're starting to wonder. Now, because of this extreme sell-off, the indicator here, the market was already overbought. You can see that now it's not oversold yet, but it's out of whack because of this gap. So what do? Decision tree is where we come into with this one, okay? So once again, we know certain factors. The overall trend is higher on the long term and also on the short term and medium term. But now intraday, which is a much more finite way of looking at the market and trading. And I suggest you don't trade intraday unless you really are nimble or very experienced and know what you're doing, because there's too much noise during the intraday trading. So in the opportunities, you have just as many good opportunities, if not more, in the longer term trades. So now here we know that we're coming near a critical support area. So the market's trading at 155. The low was here. Let's see, the low was 150. The low was 154.13 today, and the high is 156. We're trading right now at 156.75, so just below the high. So nice little bottoming action today. Could be profit taking. I mean, the market went from 170 all the way down to 150 to 3, just in a couple of sessions, 5 sessions. That's a big move. So anyone that well, if you're looking to buy into Walmart, you're probably buying into a good area. I would think that's probably what's happening today, especially since the overall market was higher. We're coming into the end of the year, Christmas time, whatever, even though they're expecting Christmas to be not as strong as perhaps the last couple of Christmases, it's still expected to be strong. So that's kind of bullish. All right. Now, in this situation, would you use a call? Well, remember, when you're long call, it's when you're most bullish. We're not really most bullish here anymore, are we? You could say it's a very good opportunity to buy here. Now, if you were thinking about buying the stock here, this is one where I'd say after a move like that and these numbers, you might want to wait and look for an opportunity to buy lower. What you could do instead is that's when a call would be a good situation. But that's because you want to get long the stock. Is getting long the stock something that goes along with our decision tree. Let's see, getting along the stock is something you want to do is a technical situation. Doesn't apply. Market bias would have fallen under that. Well, no, that's your own personal bias. So I'm not saying that you wouldn't buy a call in here. Buying a call versus the stock would probably be the better trade, especially because if it goes up, you can always exercise the call or just profit off of the value of the call as the market appreciates. And you also would define your risk, because with a drop like this, let's say there is a turn in the retail sector and all of a sudden, the next couple of weeks, the numbers start coming out bad. Let's say there's layoffs everywhere, and all of a sudden people start tightening their belt because oil shoots to 100. All kinds of things could happen with what's going on geopolitically in the world. So maybe the stock isn't where you want to go. Credit spreads, since we don't really have a directional bias, once again, directional position doesn't give us anything there. However, when you look at the straddles, okay, so is the market wedging? Does it fall into that category? Well, no, it doesn't fall into that one. Is it testing a trend line? Well, that is a totally different story. So let's go to the weekly again so we can figure out some trend lines here. So let's say we just go back to this low all the way back here. We go back to April of May of 2022, and we go off of this major low here. This also caught this last significant higher swing low. Okay, this is key. See how this stayed above that trend line? Okay, so now this becomes a very big sell area. Ironically, super trend is right there also. So 151 now is giving us a level of market pivot support, where we'll probably see a directional bias below it of bears coming in heavily. And above it, the market can hold it, maybe has the potential to get at least halfway back up to where it was before it falls down. So let's take a look at where it was. We're just trying to get some levels here. We'll go to the 50% off of this high. And get rid of this now, make the chart clear. Okay, so our indicator is showing the market has been overbought. And obviously, now here's the thing is this crossed over here when the market made a high here. Now it made a higher move high, and this indicator is still going down. What you call that is called divergence, okay? Now, what does divergence mean? Excuse me. Divergence means that you have typically when you have, like, for instance, this crossover here, the market turned, excuse me, and once again, it turned over here. So when you have those turns, you should start to have a lower move high. Excuse me. Oh, I apologize for that. Been talking all morning. So, but we should have had a lower move high because of this indicator. Since we have a higher move high, that's called divergence. That's another signal that says market's starting to say indecision. We've been bullish, but it may start to get weak. So what do we do with that? Our market bias, once again, is very confused. We know that if the trend resumes, we have a good chance of going from 156, where the market's at right now, up to 170. That's a $14 move. Then we have this situation here with the trend line. Remember, testing a trend line, we were just above it. So since we didn't test it, but we're right there, the straddle becomes the play. So let's look at, we have the market at 156, and we'll go to trading. Okay, so we have 156 for Walmart. We put in our stock trade. Okay, and now we're going to do add an option and add an option. So for a straddle, remember, we have buy to open, both options. Quantity has to be the same. Expiration is the same. Now, remember, when you have straddles, it's large move, far from expiration. So we're going to go all the way out to just after Christmas, to the end of the year. You want to be every bit of 25 to 45 when you're looking at straddles. And since this one is over 30, that's a good one right there. Now, remember, the strike price is the same. So for this one, the market's trading at 250 or 156. right? 156.78. So now let's find a strike price of probably 155. Okay, 155. So remember, once again, the strike price is the same. We put in a call, and then we put in a put right here. And we have a pricing here. We have the market is 542 at 574. Now that's a tight spread for the bid and the ask for the straddle. This is a nice thing. Now, Walmart is a very liquid stock. Lots of funds trade it. Lots of people invest in it. So also the options are very active. So pricing here is beautiful. When you can get a spread that's somewhere between 25 and 50 cents on anything like this, especially when you're dealing with different options, oh, that is very, very tight pricing. So we like that for 569. Boom. And let's see what happens here. So we have the 155. Okay. And let's see what we got here. So 155. Now remember, the stuff that we've talked about here as far as decision trees, you'll be able to watch this video on YouTube on the eOption YouTube channel. I have it on my playlist on my YouTube channel as well. And you can go over these different strategies, and then you can also review why we were breaking down these levels here. Okay, delete that. So 155 is our strike price. Now, remember what we were looking at? Why do we want to have the straddle? Immediate move expected. Well, it's not quite like the CME that was wedging. However, we're testing the trend line. We just came off a very severe break, had more movement in the last week than it did in the past month and a half. Okay, so that's a big deal. And the fact that even if the market is bearish, you usually have a profit-taking move on that. So would it be out of the realm of possibility to see the market get back up to 160, a $5 move that way? Very possible. Also, if the trend is really there and it starts to look, let's say that economic numbers are very favorable over the next few weeks. Let's say that oil stays down and people can, at the last minute start buying a little bit extra for the holidays, and even if they're not buying toys so much, they're still maybe celebrating and get together more with families and stuff like that. So Walmart's going to be busy as far as consumer staples and all kinds of other things like that. Should that occur, you have the potential to see Walmart get up to near its highs by Christmas. So you could see a $14 rally. Look at it, 5 weeks, by the way, so that's a big deal. So with that time frame going on, if you got long, remember the call situation is questionable because this market could slip. So that if the trend line holds, the straddle is good to the upside. And if it fails, remember, if this trend line fails, not only do you take out the trend line, which would be a key thing for a straddle trade to add to the volatility of direction one way or another. In this case, it would be down because it'd be falling below a trend line. You're also taking out this last higher swing low. This is key support. So if you take out the last swing low or higher swing low and the trend line, that adds to us getting to potentially hit this 143 area. So now you're looking at a $13 move. You're looking at almost the same move to the downside as potentially to the upside should economic numbers be good. So in that case, remember, you got in at just over $500 on the spread. You realize if you go from up to above 160 or you fall below 150, so which is right here. So here's 160, and we'll make this orange, and then we'll go to 150. We're off by a couple cents there. But you get the idea. So between these two lines here, the market falls below it or above it, and it's there at expiration, you're up money, period. So anything above these levels over the next few weeks, especially if it happens in the next 2 to 3 weeks, you're looking at having a nice return. So you have the potential to make more than, let's say you get down to either that extreme down around 150 or you get up to 160. You're not looking for a big move. If that happens in the next couple of weeks, you're going to, no matter what, you're breaking even, you're secured. If it gets above that, especially if you can get another $5 to $10, which if it does hit these targets, like let's say the market sells off to this target here, or it goes back up to the highs between now and expiration, you're looking at making more than 100% return on your straddle in the course of 5 weeks. So once again, it's not so much how often you trade, it's about selectively choosing the right trades in the right situations that give you the highest probability of success. That's where, once again, the decision tree comes into play, okay? So remember, there's the three variables for the decision tree. You have your strategy, which we've gone over: long calls, long puts, vertical credit spreads. We've talked about straddles, and we've also talked about calendar spreads. Now, calendar spreads, you need to have kind of a neutral trending market. We didn't have examples like that. So when you have a total sideways market, then you would use a situation, instead of using the vertical spread, you use the calendar spread. So now remember, once again, too, that the strategies that we were talking about, you have variation in movement. The credit spreads are only when you're looking for movement, but it's very short expiration. So only 2 to 3 weeks out, not anything longer than that. Okay. And the pricing has to be right. When it comes to the puts and the calls, then you want some leeway there. You want more 25 to 45 days out. Give yourself some room for the trade, and also the ability to capitalize on for instance, volatility as well as movement. Should the situation happen sooner than later. Excuse me. Then you have the straddle situation, which we're just waiting. We just want the market to move, but extreme. And also, you go out further from expiration with the straddles too, just like the calls. You want to be 25 to 45 days or more. Okay. More would be in a totally different situation for much longer term trades, where we're using daily examples. If you were using the monthly for trades, then and using the same methodology, which we're using this on a daily perspective, you can use it on a weekly, a monthly, a yearly. The further time you go out, though, you got to realize you're taking on a lot more risk and a lot more capital. This is one of those zones between daily and weekly where, especially with these option strategies, you have the highest bang for your buck. I mean, even though interest rates are going up, you have a trade where you have the potential to make 50 to 100% return in 4 to 5 weeks. That's more than you're going to make in a bank, and even with the interest rates where they're at, in a very long time. So, but remember, you don't take a trade unless the three variables line up. So we have a couple minutes left to see questions on a thing. Not too many. No one not wanted to have us look at any stocks. If you guys would have said, hey, look at this one here. Doesn't have to be my suggestion, which, by the way, we are going to have another follow-up webinar where we're going to go over the decision trees with stocks in December. Please join us, sign up for that one as well, and bring your stocks that you want us to go over, because I'm doing these were all, I just picked them out of the hat pretty much today. And I can do the same again, or just use what you guys suggest. So as long as they're, in the at the NYSE or NASDAQ, heavily traded stocks with options, we can definitely do that. All right, so let's look at Northern Trust real quick. Overall, it's been a bear over the weekly basis. Now let's look at it on a daily basis. Correcting. So we know on a weekly basis, it's overall trending lower and it's correcting. On a daily basis, it looks a little bit nicer of a trade, but it's starting to look a little oversold. So is it because the market's going higher that Northern Trust is going up? I don't know. The banking sector as a whole has taken a lot of heat over the last. You'd think that with rates going up, they'd be doing well. Some of them are, and they will. It's going to work out for them in the long run. It's just in the short run, there's been a lot of tightening on lending. So, but because the overall market's up, maybe that's why this correction is going on. Right now, the super trend oscillator here has it still in bull mode. This is getting to oversold. So short term, buying the stock, it's a tough play. A call would be if you just wanted to be long it and have the potential to exercise a call and get in cheap for low risk. That would be a situation, but that doesn't fall into our decision tree, right? Remember, for a call, you need to be most bullish, very, very, very strong bull. Not a strong bull here. Overall trends down. Don't want to try and pick a bottom. If anything, this may be an area where it starts to run out of gas. So let's just look at this last major swing high here. And this right here, yeah, we have this 0.382. So 77, yeah, we're coming into this area where, this became resistance, and now could it become support? It'd probably be resistance once again. So for a call, it's not worth that situation. For a credit spread, are we looking for a large move to the upside? Not really. On a weekly basis, it looks like it's starting to turn, but on a daily basis, it could be a little stretched. So the call for a couple of weeks, for a month, that's tough. To go out into January with the rolling of the quarter and new year, and you still have a Fed meeting then coming up, that's probably tough on a banking stock. And once again, we don't have the three variables that are met. But what about a straddle? Okay, is an immediate move expected? Well, with the indicator stretching and the correct, if this is a correction, then a turn is likely, in which case then you'll see a nice sell-off. If this market is truly turning and the strength of the broad market is helping to lift it, well, maybe you're getting a Christmas a rally and you're going to see yet, I mean, this market could still keep going higher. And remember, indicators are lagging. Just because this one here is saying the market's overbought doesn't mean that it is yet. It can be like this for 2 months at these levels, dangling around. It can actually get to the point where this market keeps on rallying and this indicator turns down to oversold, which means that's how strong it is. So we have confliction there. So we don't have the technical basis to do a calendar spread. We don't have the technical bias to do a vertical spread or a call. A put is a little rough because we were taking the overall longer term trend bias, but we're trying to pick a top on the correction. Never a good idea. So what's a good idea then? Well, straddle. Is the market wedging? Well, it's definitely not wedging. Is it testing a trend line? Well, that's a very good one. So let's go back to this weekly here. So, and let's make it a little tighter. Okay, so remember how we had this high back here. Oh, let's see, sorry about that. Let's get the trend line going. It's so far back here. Oh, sorry. Let's get this example. I'll get this example done before we're done. I got 3 minutes. I can get through this. Okay. All right. So testing trend line, number 2 factor, cluster of closes. Well, cluster of closes, not really, but actually, if you look at it, except for this little swing here and swing here, going all the way back to April, yeah, it's between 70 and 75. So that's kind of right there. So bullish bias, no, but how about straddle? So 75.68, we're going to go to NTRS, and we're going to go to options, and we're going to go to buy to open. Remember, when you're buying a straddle, quantity is the same, buying to open is the same. Expiration, we're going to go to the December, and then the strike, let's see, what was it again? It was 75.67. So we're going to look for the $75 strike. Remember, the strike price has to be the same price. And then we do one call and one put, and that is for either 1620 at 1680. So it's an expensive straddle, but considering the potential for market movement here and the volatility, I think this is a good call here. So we're going to verify this one here. So for 1684, all right, so 1684. All right. Now, the nice thing is let's say the trend goes back and it continues to make lows. Well, this last low here is 62. That means you're going to probably get down below $60 a share. That's at least a $5 move. Now, we're testing this trend line. We also have the super trend oscillator here. So we have this oscillator here that just turned on a daily basis. We have the trend line, which is being tested, plus we have the super trend, which is just below it right there. If it takes that out, there's only one last key thing to take out, which it'll probably test this high here, which is at $82. So that's a $7 move right there. That $7 move right there will start to put you into a rising volatility. You're breaking out near a new high or an old high. That should bring back, we should raise volatility. Open interest and volume will probably increase, which will drive up the demand for the call side of that straddle. And that should outweigh the decreasing value of the put. And if you do have a nice, say, explosive rally, which you could, I think that $7 rally could turn into a 10 to 15 over the next month before Christmas. And if that's the case, well, then you're looking at probably making upwards of 50% on the straddle. Remember, straddles, you don't have the highest potential as you do with outright calls or puts, because those you're taking on, you're just taking a line in the sand on direction. The straddle, it could go lower, it could go higher. So we are here at the end. There was no questions right there. So at this moment, I am going to turn this back to Gina. Thank you all very much for your time today.
Okay, great. Well, thank you so much, Teddy. That was very interesting and informative, and we appreciate you taking the time to work with eOption to present this webinar. Before we go, I just wanted to highlight a few points on the screen. Again, eOption, we charge some of the lowest rates in the country to buy and sell stocks and options. You can trade stocks and ETFs for zero commission for unlimited number of trades. And then options are just 10 cents per contract plus $1.99 per trade. And we do have, as you saw, Teddy was using our paper trading platform. So that is very similar to our actual trading platform. So if you want to give us a test drive, you can open a paper trading platform, or else you can feel free to open an actual account and get started with trading right away. There is no minimum to open an account. So once you fill out the account application, if you go to our homepage at eoption.com, you can see that. And Teddy, I'm not sure if you want to put that screen back up with the items. I think we just lost that. If you go to, there we go. And then if you go to eoption.com, we do have the second point on the screen. We have option strategy resources. So some of the items that Teddy was mentioning, like a vertical credit spread, a calendar spread, or a straddle, if you want to learn more about those strategies, feel free to go to our homepage, and you can go under resources, and you could find strategies there. And there's videos, and there's descriptions of when you would use all of those different strategies. So that's real helpful. And as Teddy mentioned, you can also go on eOption's YouTube channel, and we do have lots and lots of videos on there that also will go in more detail on some specific option strategies. And again, you can go, you can subscribe to our YouTube channel, www.youtube.com/eoption. And there you'll see all our past videos. And if you hit the subscribe and notification button, you'll be notified whenever there's a new video on there. And in our eOption, when it's live tomorrow on YouTube, we will have a promotion, a limited time promotion for free stock if you open an account. So make sure to check that YouTube promotion in the next day or so. And then finally, our next webinar is coming up. Teddy will be giving the next one. It's our last one of the year, and it's called Santa's Secrets for Option Trading Success. And that is on Wednesday, December 13th at 1 p.m. Central Time, 2 p.m. Eastern Time. So mark your calendar, and you can also register as well at www.eoption.com/webinars. So at eOption, we're always here for you. If you have any more questions or anything you saw in the webinar, or any strategy you'd like to discuss, feel free to contact us at any time. You can also shoot us an email at support@eoption.com, and we'll be happy to answer that for you and work with you. So again, thank you again for your time. We greatly appreciate it, and we hope you and your families have a wonderful holiday and a happy Thanksgiving. Bye now.